Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist and the head troublemaker at Wealth Press. I'm just giving you guys a hard time. Good morning, everyone. It's Wednesday. It's July 20th. It's actually my middle daughter's, or actually my oldest daughter's and my middle child's 18th birthday today. I survived the first 18 years. I think I deserve a t-shirt that says I survived the first 18 years. Anyways, it's about 7:59 in the morning. The market's going to open up in about an hour and 31 minutes to be very specific with you. And we're finally seeing a down opening. We've been seeing all these up days. It's about time we see some amount of consolidation or some degree of consolidation, especially in this crazy market we've been in. Now, before we begin and before I get into my analysis, I want to explain something to you guys right now. And this is not a cop-out, but I'm just being realistic with you right now. We've been seeing, over the last several months, we've seen major sector rotations. We've seen energy go from first place all the way to last place. We've seen consumer stocks go from literally last spot to first spot and everything in between. The reason that's happening right now is various sectors are trying to find their place right now. And the reason that's happening right now is because we don't have a clear-cut direction of a trend. We could be going into a recession or we could be already in a recession, or we may find out that there may be a recession looming, but not for the next couple of years. So it's these three scenarios the market is trying to ascertain and trying to assimilate where we're at. And the trouble is this: we're in the middle of a war. We had the COVID. There's a lot of things being thrown at us. And this type of an economy is not a very, very typical economy. This is not a typical square recession or depression. It's not. It's very different because consumers are still spending money. Meanwhile, some sectors are going up due to inflationary pressure. Some sectors are coming off. The point is there's a lot of unforeseeability in the market. There's a lot of unforeseeability with energy. If we find out that we've already kind of been in a recessionary environment and we're getting out of it because core CPI is is going lower, that means energy and consumer staples will subdue, and tech stocks could rally again, and consumer stocks can rally again. If we find out that a recession is closer and we're not getting out of this out of these conditions, then we may be in an inflationary pressure for a while. We would see energies rise again, consumer stocks rise again, and tech stocks fall again. So it's a very, 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 very complex situation right now, and we need to figure out which of these three doors we're going to go in. Until we get there, we're going to see some of this consolidation. So be very, very patient with the market because there's a lot of unforeseeability right now. First half of this year wasn't that bad. We knew we were in really bad inflation. So we had all the inflationary sectors rise. Now, we don't know if we're getting out of it, if we're getting deeper into it, or we're far away from it. You see, it's a moving target, and the market is ascertaining everything in its price about 6 months down the road. So I wanted to explain this to you before I get into this video because there's a lot of unknowns right now. On that note, let's begin. So we have existing home sales coming out. The report has been fair. I mean, we know the numbers going to be coming down a little bit because interest rates are going to go higher. But so far, the numbers were pretty good. Matter of fact, we had housing starts and permits yesterday, and the numbers were not that bad. They weren't like amazing. They didn't run away. But look at this. The range 1.5 million. We had it right in between. The consensus here is on the upper end too, between 1.6, 1.75. We came in at 1.65. So housing starts and permits are not that bad. We thought they would be really suppressed by now because of the higher inflation, but they're not. Existing home sales today are coming out at 10 o'clock in about an hour and 57 minutes. And I don't think the report is going to be all that bad. Consumers are still spending. The consumer discretionary and the consumer sentiment data last week was positive. So markets are really in a very peculiar place right now because things can turn around on a dime. At the same time, if we continue to see these consumer discretionary, if we continue to see tech breakout like it did yesterday. I mean, look at that. That's a legitimate breakout, a nice ascending triangle. And if we see the bond market remain in this type of environment, let me just show you. In this choppy environment, that means, and actually go higher, that means interest rates do not want to go higher. They want to go lower. So we're in a wait and see zone right now. If we trade lower, things are going to get worse. If bond market trades higher, things are going to get better. But if you notice, a lot of the stock sectors are taking on this choppiness that we're seeing from the bond market. That's coming from the bond market. And that's because we just don't know what's happening right now. All right, let's get into global analysis, and then I'll get into the nitty-gritty for you. Shares advanced in Europe and Asia on Wednesday, but after Wall Street rallied to its best day in more than 3 weeks, a lot of the reasons why we're rallying is because of a lot of the analysts have underestimated the earnings. They go way too far, and the numbers have actually been coming better than expected. Later today, I'll give you, if you're in my VIP room, I'll give you a full earnings update. I wanted to wait till about 50, 60 companies reported. Investors are watching for signs that a decade-high inflation may be peaking. Core CPI, folks, this is the third. We had the worst number 2 months ago. Last month's number was not that bad. This month's number, obviously it's tracking last month's number, was not that bad. It was actually lower. Food prices, energy prices, metal prices, they're all going down. That's signs that inflation is peaking. European Central Bank is expected to raise interest rates on Thursday for the first time in 11 years in hopes of knocking down inflation, and Japan is doing nothing. China's central bank kept its loan prime steady on Wednesday despite latest data showing significant slowdown in growth past quarter when the pandemic-related shut down many cities and other activities. But China has promised to really gear up, hoping they're going to keep their word. Federal Reserve is going to raise rates. The only question is, are they going to raise rate 0.75 or a full basis point next week? The odds of a full basis points have been declining, so it looks like it's going to be 0.75, which is already priced into this market. And remember something, folks. Stocks are pricing in prices where we think they're going to be 6 months from now in terms of the economy. And most analysts are expecting the worst period to be behind us over the next 6 to 9 months. Just saying. So prices may be at their lows. Tesla is reporting earnings today. Here is the numbers. Here's what everybody who's reporting today. I wanted to give you a nice little, here's the EPS. You may want to just take a screenshot or write this down. I think they're reporting after the close, and they're looking at $1.81, which is a 25% increase from a year ago on 38% more revenue. That's huge. If they can do that, that would definitely help us make the case that we are not going into a recession, that we're just in an inflationary period. But again, it's a balancing act. We also have Biogen, big biotech coming out. Another one, laboratories, healthcare, bank stock, railroad here in Jacksonville. NASDAQ, want to see if numbers are increasing or decreasing. Really interested in the NASDAQ one. Not so much in the number, but what they have to say. But Biogen, Abbott, CSX, NASDAQ is going to be pretty big. And obviously, the big one that everybody's waiting for is Tesla. And I honestly have no opinion how they're going to do. They've been, here, let me just go through a chart here for you. Tesla's been knocked down pretty good lately. And it's been up last few days. It looks like it's basing out. And it looks to me like it wants to go higher. It really does. Look at this. Look at that nice base it's been building. And if you notice, most of the tech sectors have a very, very similar base that they're building. This ascending triangle base is very healthy. And you will notice it's not all that different from what you're seeing from the bond market. Again, everything is following. When did this start basing? Around January. Let's see here. May. Let's see here. Right when the right. Yep. Right around almost the same time. So as you can see, the bond market is very much responsible for what we are seeing right now on Wall Street. Now, we've got sector watch. Now, sectors, we've been all over the place. And this is what I mean. The market is trying to find itself. It's trying to find one of the three doors, whether the worst is behind us whether we've got really bad stuff happening real quickly ahead of us or far away ahead of us. Those are the three factors. Those are it. And right now, the market is trying to find its balance. Like yesterday, you had communication services and then industrial and energy right behind it, and then you had consumer discretionary. None of this makes any sense whatsoever. That is a completely fragmented market, which, by the way, the sectors are telling us as well. This is a consolidation. Usually these consolidations happen after long trends. So there's a good chance we're going to go higher and not lower right now. Again, let me take you back to these sector rotations. Now let's go back 5 days. You got consumer discretionary and energy and infotech. You've got the most bearish sector and the most speculative sectors back to back, and then consumer staples is all the way on the bottom. I mean, it's impossible to, there has been zero consistency in this market, and it's driving me bananas. Over the last month, we've had a lot of consistency. We've had consumer stocks, speculative stocks, healthcare, information, consumer discretionary. Healthcare is neutral. Rally, and look at where energy and consumer staples is. Where's consumer staples? Where is consumer staples? I don't see it. Here it is in the middle. But the point is, we've been the strong stock, the speculative stocks are rallying because, again, it looks like we may be getting out of this faster than we thought, or things are not as bad as we thought. Those two scenarios. If you look at each individual sector, I love consumer discretionary. It's breaking out to the upside right now. Healthcare is choppy for obvious reasons because discretionary stocks are breaking out. Real estate is moving higher, which I'm surprised about, but it's actually looking better than I thought. Nice breakout right now in tech. Look at that. That's a breakout right there, a multi-month breakout in tech. Financials are okay, still in a range, I suppose. Utilities aren't going to do anything if the speculative stocks are rallying. Consumer staples are in the same boat as healthcare. They're waiting to see how long this rally in discretionary stock lasts, and if it doesn't, they'll resume their trend again. But they're holding up pretty well here. Communication services is breaking out. Tech. Look at that. Look at that breakout. And also a breakout in financial, which is kind of interesting. Most of these stocks are having a rounded bottom, so you can expect more upside, but expect volatility, congestion, volatility, and not too much directional bias. Let me see if chips are breaking out too. Let's take a look here. Yeah, look at that. I knew it. I smelled it coming. Nice breakout right there. So there's the next support, the resistance, is at 247 for the SMH. Let me give you some levels for the various indexes. For the QQQ, there's a major resistance at the 314 level. For the Dow, looks like we're right there. We're literally like right there. If we go up maybe 32,000, if we can get past 32,000, we're going to be back to where we were before the nasty 8.6 CPI took us all the way down. But we need to see that. We need to see us break above 32,000. Not sure if that's going to happen or if we're going to come back down and again congest and consolidate. But that's what's on the table right now. On the QQQ, which I showed you already. How about the SPY? On the SPY, we're right there. We're literally right there. If we go up to the 394 level, we're there, and we'll start filling this back up, and then the next level is 418. But let's see if we can get past this or if we back down and go back into the range. Remember, this range has been rather tight, so there's a good chance we can back away from it as well. But I like what I'm seeing right now. I like the overall market. And today, it's Wednesday. What do I do Wednesday? I give you a long trade and a short trade. For the long trade, I like AutoZone. I really like AutoZone. And again, consumer discretionary stocks are breaking out. This stock is near swing highs right now. Look at where we're at with this stock. And according to analysts, earnings for stocks, for these type of stocks, for car stocks, are going higher. This is near a all-time breakout right now on a nice ascending triangle. This could break out nicely and move another 200-300 points to the upside. So I like AutoZone. For the short side, this Walgreen Boot Alliance, I mean, look at this downtrend. It just goes down, and it looks like it went up for a few days, and now it's ready to come down again. So this Walgreed Boot Alliance just doesn't look all that sexy. It's probably a really good short right now. So that's what I've got for you today, but I've got something even more important. Folks, for the last 6 months, I've been using high-powered algorithm to test all my candlestick patterns that are known to exist, objective ones, the ones that have concrete rules. Some of these are old patterns created during the 18th century by a rice merchant. We got to go back in time sometimes to find the good stuff. The patterns were not developed to trade the modern stock market. And as you'd imagine, some of the patterns, they're junk. Matter of fact, I only like 5 of the 64 that we tested. But a handful of them, according to my testing and live trading, have worked incredibly well. I mean, really, really well. I just put together a training showing historic win rates and profit factors for the top patterns, giving you the name of them, giving you a full back test on the S&P 500 over 10 years, really good actionable data. Plus, I'll show you real life trades and hand you actionable trading idea. How about that? Best part, I'm not charging a single penny for this extremely privileged information. And when I say extremely privileged, I mean it. Not everybody's going to get access to it. There's a lot of data here. Check it out now. If you're expecting to see Ferraris and Lamborghinis, you're going to be disappointed. Meat and potato only. I'm not charging you a single penny, and I expect you to check it out, especially if you want to get my 5 patterns for free and their back test data. You've got to get it. You've got to check this out. Click the link below to get my 5 patterns for free. And if you're in the YouTube channel, go to the YouTube Wealth Press channel and you'll find the video there. It's below the video. Bye, guys. Have a great day. Comments, feedback, love letters. I want to hear from you. I miss all of you. I know you're having a good summer and I'm missing out. Support at marketgeeks.com. Bye, guys. Have a great, great day.